let's get started. Good afternoon, everyone. I'm Douglas Eakley, and on behalf of the Rutgers Law School Center for Corporate Law and Governance and the Rutgers Institute for Professional Education, I want to welcome you to our webinar, 10 years after the Dodd-Frank Act, looking back and looking forward. As the program caption indicates, this is the first of a virtual symposium series focusing on Dodd-Frank, with today being past is prologue. Before I turn the podium over to our moderator and panelists, please let me acknowledge and thank Rutgers Law School alumnus Bruce Ortwine, whose generous financial support has made this program possible. Let me also acknowledge and thank alumni Curtis Tao and Jared Anderson, who took the lead in putting together not only today's program, but the symposium series. And with that, Jared, let me turn the podium over to you. Jared Anderson is Vice President and Senior Counsel of Wells Fargo and Company, and the former Regulatory Policy Advisor, Banking Supervision and Regulation Board of Governors of the Federal Reserve System. Jared.
Thank you, Doug, and thank you to the Rutgers Center for Corporate Law and Governance for hosting us. It's an honor to be here with you all, and I'm excited to be moderating today's panel with such a distinguished group of industry experts. I'll avoid extensive recitations of bios, all of which are incredibly impressive, but I did want to briefly introduce our panelists who will be providing brief opening remarks, and following their remarks, we'll then open up a dialogue among panelists, and if time permits, we'll do a brief Q&A to close the session. For those of you that may have questions, feel free to include them in the chat or Q&A function in Zoom. So we have 5 very distinguished experts with us today. Bill Brenton, the Nicholas Galasio Professor of Law at the University of Pennsylvania and co-director of the Institute of Law and Economics will speak first, followed by Catherine Judge, who's a Harvey Goldschmidt Professor of Law at Columbia Law School. We also have Jim Bergen, who is Deputy General Counsel and Senior Vice President of Legal from the Federal Reserve Bank of New York. And during the financial crisis, he was Chief of Staff to New York Fed President Bill Dudley. Tom Baxter, who is of counsel at Sullivan & Cromwell, will be joining us shortly. Tom was the former General Counsel and Executive Vice President of the Federal Reserve Bank of New York during the last financial crisis. And we have Charles Yee, who is a partner at Arnold & Porter, former General Counsel of the Federal Deposit Insurance Corporation, the FDIC, and was former Majority Staff Director and Chief Counsel of the Senate Banking Committee under Senator Chris Dodd. So I will yield the floor to Bill Brenton now, and I think Bill has some slides that he's going to share with you all. So
thank you very much. Am I unmuted?
Yeah, you're good.
Okay. Thank you. Just let me go into. All right. The financial crisis. I'm going to talk about the origins of the financial crisis. It began with a housing bubble. A bubble that rose when a glut of cheap financing enabled borrowers to bid up home prices above fundamental values. Much of the cheap financing came in the form of non-traditional mortgage products. There was a shift in the market's product mix from a 30-year fixed-rate, fully amortized mortgage to adjustable rate loans with teaser rates, interest-only or negatively amortizing payments, or balloon structures. The new features kept initial monthly payments down, enabling borrowers to bid up housing prices. The non-traditional mortgages were frequently made at high loan-to-value ratios, further enabling prices to be bid up. They also frequently were not fully documented, which enabled borrowers to obtain larger loans based on inflated stated incomes, which let them further bid up house prices. At the same time, people with ever weaker credit scores became qualified to borrow, resulting in more entrants into the housing market, which once again bid up prices. So just where was all this credit coming from? There was a shift in the housing finance channel from regulated securitization by the government-sponsored entities, Fannie Mae and Freddie Mac, to unregulated securitization by private actors. Securitization is the process of producing debt securities, the repayment of which comes solely from a discrete and segregated pool of financial assets rather than from the income of an operating firm, income that might be subject to claims of competing contract counterparties and tort creditors, or which might vary based on management strategies. Now, this supposedly facilitates investment in carefully targeted risks. In the prototypical mortgage securitization, a sponsor firm assembles a pool of residential mortgage loans, either loans it's made itself or loans that's bought from third parties. Original lenders, known as originators, may or may not be insured depository institutions. The sponsor then sells the pool of mortgage loans via a subsidiary known as a depository to a special purpose entity or SPE, typically an owner trust. The SPE is a shell. It finances the purchases of the mortgage loans by issuing debt securities in the public bond markets. The debt is a liability of the SPE and not the sponsor or depository. Its repayment is backed only by the SEC's only asset, the right to collect payments on the mortgage loans. In this case, the SPE securities are called residential mortgage-backed securities, or RMBS. Now, as noted, RMBS production was originally the preserve of the GSEs, which not only sponsored but guaranteed the SPE investors their payments of principal and interest. The GSEs only purchased and securitized mortgages that met strict underwriting standards, and so generally excluded non-traditional mortgage products. In the years preceding the financial crisis, however, GSE securitizations, that's the blue line, lost substantial market share to so-called private label securitizations, that's the black line. They had commercial and investment bank sponsors. Private label securitizations had laxer underwriting standards and were the source of financing for most non-traditional mortgages, including subprime mortgages. The hallmark of private label securitization was a senior subordinate credit tranching structure. With tranching, rather than having all of the SPE's debt have an equal rate and rateable share of the risks and returns on the mortgages, some securities were junior and bore more risk, and some securities were senior and bore less risk. This allowed private label securitization to produce AAA rated securities out of pools of dodgy subprime mortgages by concentrating all of the credit risk on the structure's junior tranches. This AAA paper met an enormous global demand for top-rated debt securities, a demand stoked by a limited supply of AAA corporate debt. Indeed, in the years prior to 2008, structured offerings made up most of AAA debt stock, but there was a catch. The senior tranches got AAA ratings only because the risk of loss fell on the junior tranches. There was a problem finding buyers for that toxic junior byproduct, the sale of which was necessary to the economic viability of the offering. The solution was re-securitization. Junior tranches were bundled into new securitizations called collateralized debt obligations, or CDOs. Here, instead of mortgages being securitized, junior debt securities secured by pools of mortgages were themselves securitized. CDO repackaging meant a corresponding lift in credit ratings. The CDO's senior tranches bootstrapped junior paper into investment grade status, supported by a formal exercise in the microeconomics of portfolio theory that would turn out to be completely bogus. In some cases, junior tranches of CDOs were themselves re-securitized into what were called CDO squares. Thus, was gold standard debt manufactured out of dross mortgages. But supply was limited by a finite supply of mortgages and didn't satisfy global demand for top-rated debt securities. The investment banks met some of that excess demand with a synthetic version of the CDO, the most famous of which is depicted on the slide, that referenced existing CDOs without actually re-securitizing any existing debt, magnifying the quantum of financial risk taken on the overall mortgage pool. These structures conjoined debt interest reference to CDOs with credit default swap positions. It thereby allowed speculators in the financial markets to take short positions on portfolios of CDOs. Those on the short side of these arrangements did fantastically well during the financial crisis. the Big Short Paulson hedge fund, most prominently. Those on the long side, most famously German banks, were often wiped out. Finally, in the run-up, a wide range of financial institutions used their investment-grade CDO tranches to collateralize short-term borrowing in the repurchase or repo market, a super short-term debt market on which many large financial institutions were relying for a surprisingly large part of their funding. Let us now watch the dominoes fall. Global financial crisis began when US housing prices flattened and then began to fall in 2006, even as the Fed, worried about inflation, was hiking interest rates, resulting in nasty surprises for subprime borrowers whose teaser rate loans were expiring. The housing price declines and interest rate increases triggered credit contraction, as it happens. And because most home purchases are made on credit, the credit contraction further depressed home prices. The second sign of the crisis appeared when lenders to non-bank subprime mortgage originators began to call their warehouse lines of credit. With the warehouse lines pulled, non-bank subprime originators started to fail beginning in December 2006. Here, the most prominent name was an outfit called New Century Financial, which went down in May 2007. Credit then began to contract more generally, causing housing prices to fall further. Structured investment vehicles, or SIVs, were the next domino to fall. SIVs were investment entities, often but not necessarily, organized by banks on an off-balance sheet basis. They financed themselves by issuing medium-term notes and commercial paper. Bank SIVs engaged in a simple durational arbitrage, financing longer-term assets, like CDOs, with shorter-term liabilities. In the summer of 2007, investor skittishness about mortgage assets made it impossible for the SIVs to roll over their debt. They were forced to go into wind down, a negative shock to the banks. This further constrained the flow of credit to the mortgage market and added to downward pressure on house prices. From there, the downward spiral spread throughout a highly leveraged financial system. Credit rating agencies began downgrading outstanding private label securitizations, finally, in July 2007. That riled the repo market, where financial institutions were collateralizing their short-term funding with securitized paper that had been assumed to be safe. All of a sudden, it wasn't. The value of repo collateral became uncertain, so lenders either demanded more collateral or called their lines of credit entirely. There were also margin calls extensively in the credit default swap market. All of this further constrained the liquidity of the system and added to downward pressure on home prices. Bear Stearns, an investment bank heavily invested in securitized paper and dependent on repo financing, went down in March 2008. Happily, its lenders got bailed out. Lehman Brothers, similarly situated, went down on September 15th. When its lenders did not get bailed out, markets, uncertain which firm might fail next, froze. Let's unpack that. Notably, as of September 15, 2008, the collapse in home prices had not led to immediate large-scale losses on home mortgages. Most loss recognition on mortgages occurred after the crisis broke. Losses booked between 2007 and third quarter of 2008 amounted to just 11% of losses, total losses recognized between 2016, which was prior to this year, the last year with an elevated level of mortgage charge-offs. The trigger for the crisis was instead the market's recognition of coming losses on home mortgages and instruments directly or indirectly secured by them. Although it was clear by the fall of 2008 that there were going to be massive losses on home mortgages, it wasn't clear just how massive those losses were going to be. More importantly, maybe, it wasn't clear where those losses were going to fall because of the opacity and interconnectedness of the financial markets. Systemic risk. The uncertainty triggered the market freeze. Valuation uncertainty affecting all mortgage-related exposures put into question the solvency of many highly leveraged financial institutions whose counterparties suddenly refused to deal with them. Moreover, to the extent that an institution was a lender to firms with large mortgage market exposures, its own solvency became questionable due to uncertainty about its ability to recover from its borrowers. Uncertainty about the extent and allocation of mortgage losses meant that nobody could be sure if a given counterparty was impaired. No one could adequately price the risk in any event. So banks stopped lending to each other. The securitization pipeline was completely dry. The commercial paper market collapsed, and investors herded out of money market funds. Substantial intervention by the federal government followed. I turn that matter over to the panel's other members, beginning with Catherine.
Thank you, Professor Breton. So I guess turn it over to Professor Judge.
All right. Well, thank you so much for kicking it off. And I thought my charge was in part to compare the last crisis to what we're doing right now. So I'm going to do that a little bit rather than just talk about the interventions last time, but the two are a little bit intertwined. So just as a starting point, there are three key differences when we're looking at what happened in 2006, 2007, 2008, and 2009, and what we're going through right now with the COVID crisis. The first, and I think the most obvious to everybody, is the nature of the shock. As Bill beautifully just laid out, in the last crisis, there was an endogenous buildup of risk within the financial system that eventually threatened the health of the real economy. Here, instead, the shock was truly exogenous. We instead are facing a pandemic that nobody saw coming. And so that really changed the overtone of the conversation about the nature of the challenge that we're facing. Second is the speed. Another thing that Bill did beautifully there was to show how we really had a slow buildup. There's oftentimes a lot of hype around Lehman weekend and kind of the energy and the concern of Lehman weekend. But as we just saw, there were meaningful weaknesses in the housing market starting in 2006. There were widespread downgrades in the summer of 2007. And I think most people who look closely at the crisis would say the last crisis started at the latest in August 2007, where we really saw meaningful dysfunction in the short-term markets following the failure of BNP Paribas, and where we had the first, intermediate interventions by the Fed and the ECB. So there was 13 months between when the crisis started and Lehman failed. And going along with that, not only was the speed of the crisis, the evolution of the crisis slower, but so was the speed of the response. So what we saw during those 13 months is the Fed regularly met. They would go in a little bit. They got involved in a number of different ways. They developed some innovative facilities, but it took time for them to come up with these innovations. And I think there was still a lot of uncertainty in their minds regarding the nature and the size of the magnitude of the challenges that they were facing. It was quite, and then of course we didn't see Congress coming in until after Lehman failed. So it was not until the fall of 2008, well over a year into the crisis, that we had the Emergency Economic Stabilization Act, which was the first real effort by Congress, apart from some housing legislation, to deal with the crisis. Here, first, the Fed was far, far more aggressive. So we saw, again, this hit everybody out of the blue in March. So people were very quickly out of work. People were very quickly facing dramatic changes in their lifestyle. People were facing a really sharp decline in the stock market. And the Fed stepped in very quickly. They did so partly through monetary policy, cutting rates really quickly, and of course, committing to keeping rates low. They also engaged in a lot of quantitative easing, effectively committing to unlimited quantitative easing. That was in part monetary policy, but this time, different than last time, we also that was efforts to stabilize the treasury markets, which people hadn't, I don't think, expected to see the degree of dysfunction that we saw in March. And they came in quite aggressively with emergency lending facilities. So they rolled out all of the facilities that they had used in the last crisis and came up with some new ones. It took them longer to actually implement those, but they announced those way back in March. In addition to the Fed coming in far more quickly, Congress came in far more quickly. So we saw Congress in the CARES Act providing a huge amount of fiscal support. So they were providing fiscal support directly to small businesses. They were providing fiscal support directly to individuals, to any household making less than $99,000 a year, got some kind of check in the mail at some point in time, or money showing up in their bank account. And we also saw the expanded unemployment. And so we really saw a lot of additional money going from the federal government into the economy. So from the different nature of the cause and also the different government response, there's a lot of other differences that flow from that. So one, the political economy looks very different this time around. I have to admit, as somebody who spent the better part of the last 10 years really focused on the last crisis and the Fed's response to the last crisis, I never would have guessed that the Fed could come in as quickly and aggressively as they did. And not just that, but they came in a way that has really helped large public companies far more than anybody else, just given the nature of the tools that they had available. What we've seen is their ability to come in, just signal that they're coming in, resulted in a dramatic reduction in spreads in the corporate bond market. And that has just led to proliferation of issuances in ways that really benefited outstanding bondholders, but also outstanding equity holders. I never thought we'd see that without a huge public backlash, and we really haven't seen that. The political economy is much, much different this time around, even though in some ways some of the Fed actions might be more controversial. Second, because of the aggressiveness of the response, I don't think we know as much about whether or not this might otherwise have caused a greater financial crisis. So we are still facing a very significant economic crisis. That crisis may yet evolve into a financial crisis, but we are not yet in a serious financial crisis. Part of that is because of the many reforms that we've engaged in over the last decade. Banks went into this much better capitalized that allowed them to absorb a lot of additional risk. On the other hand, it's also because of that aggressive action by the Fed and Congress. So the Fed just provided a huge amount of liquidity very, very early on, and Congress came in, and in helping households, they were also helping out the financial system because they were making it so borrowers were far less likely to default. So we certainly saw some problems. When you look at money market mutual funds, you look at open-ended debt funds, there were definitely signs of meaningful dysfunction in March, but I think there's a lot of areas, whether it's banks or CCPs, where everything looks like it went all right. But when you talk to people, you oftentimes still get a little bit of a different story. And that's partly because the aggressiveness of the response by the Fed and Congress in a nice way changed the trajectory that followed. And I guess I'll just close off by saying, I think we're still facing some really interesting questions, both about how to help the economy in the face of this type of exogenous shock. I mean, we know fiscal support is necessary, but where and how to deliver it. There's still some debate going on, and some just politics going on. And I think we're also facing some really just interesting questions about the future role of the Fed, both during periods of systemic distress and otherwise. So I think last time around, even though the Fed was engaged in an incredible amount of innovation, and it really was innovative, we saw starting all the way back in the fall of 2007, Chair Bernanke regularly saying, this is Bagehot's dictum. This is what central banks have been doing for hundreds of years. It's providing liquidity support against good collateral to solvent institutions. And the reason it was necessary to be so creative is we'd gone from a world where we just had a banking system to what we just saw Bill beautifully present in his PowerPoint, which was a market-based system of intermediation that sat alongside that banking system, was interconnected to it, but it was engaging in the same kind of liquidity transformation and maturity transformation, so it was also fragile. This time around, Congress gave the Fed, with Treasury, $454 billion to engage in credit policy. The Fed has used only a small fraction of that money. There's very different stories about why that is, given the ongoing pains that we're facing in the economy. But I think there are really big and interesting questions about, should the Fed have a credit policy? What should that look like? And then also, as we're looking not just domestically, but internationally, at a place where the natural rate of interest might be getting lower, whether or not this is a tool that the Fed potentially should be using outside of crisis periods. And I have very personally mixed feelings about all of that, but I think there's an open debate to have there about even what the Fed should be doing to help the broader economy.
Great. Thank you so much, Professor Judge. So I think now we'll turn it over to Jim Bergen.
Okay, thank you, Jared. Before I get started, I need to do two things. First, I gotta say my remarks today are my own and they don't reflect the views of the Federal Reserve Bank of New York or the Federal Reserve System. That the second thing I have to say is that I am also a Scarlet Knight. So I graduated from Rutgers in 1995. So I have experienced many horrible football losses like many of you out there, I assume. So I'm going to do a bit of a different thing today. The professor's presentations were great. I got asked to comment on my experience at the Fed during the financial crisis of 2008. That was originally my mission. Then I got asked to then comment as well on how this new financial crisis compared and contrasted. So I'm going to try to do a little bit of both. And, you know, sort of set the stage there. I should say that during the financial crisis of 2008, I was not chief of staff to President Dudley. I was chief of staff to President Dudley a bit later, more in the regulatory reform period. Back in 2008, I was a lawyer at the Fed, actually working for the next panelist who will appear, Tom Baxter. So, you know, I thought I should just set that forth because what I'm going to talk about a bit is influenced by what my jobs were back then. So I think one way to think about 2008, I was a relatively junior lawyer. I got assignment after assignment during the financial crisis. It was a very busy time at the Fed, as you can imagine. I remember being at a meeting on a Sunday night once, and I came back to my office and somebody had placed a cot in there, which I thought was very thoughtful, and I looked at it a lot, but I actually never had time to sleep in it. But it was good to know it was there. When I first came to Fed, I came to Fed in around 2005. I had done 5 years at a law firm, but I didn't know bank regulation at the time. And I remember pre-crisis, I kind of didn't get the concepts of bank regulation very well. There was a lot of focus, it seemed, at the time about, you know, who controlled who in terms of a bank holding company, and a lot of focus on, the thing called 23A, which I did not understand about what you could and couldn't do with a bank within a holding company. And I pre-crisis, I didn't really get it. And then, I got it because the financial crisis kind of made clear like why all those things mattered a lot. If I had to say like broadly, New York Fed, at least my part of the New York Fed, part of the interaction with Professor Bratton's presentation is, as you saw these shocks hit the financial system, was the financial system, the core financial system, ready for it? The core financial system is supposed to have a bunch of things that are associated with it to make sure that it stays safe and sound no matter what shock arises. You're supposed to have capital and liquidity so it can withstand a shock. You're supposed to have supervision so that, like, if those capital and liquidity standards are not enough, you can respond to them. And you're supposed to have emergency liquidity for those institutions at times subject to restrictions. Back in 2008, that was not the core of our financial system, was kind of not well defined, let's say. And I think one of the things that, at least from my experience in New York Fed, was what we were responding to was there was just instance after instance where the fact that you didn't have that well-defined core and well-protected core was causing problems. So I thought I'd just give like sort of 3 assignments I had in 2008 to give you a little bit of an example. It was exciting, 2008. So first, I was a lawyer, but then I sort of got traded to our open markets desk in the beginning of 2008. This was kind of like a professional development opportunity to try to like learn stuff about a non-legal business. So not knowing anything about market stuff, they gave me a kind of a boring job, or at least what it was perceived to be a boring job. And I remember I had to do calls to dealer funding desks to see what, on what terms they were getting for lending repo. And that was usually very boring, but as Professor Bratton just talked about, it rapidly became not boring. And we had the intervention that he described with Bear Stearns, where we lent in order to facilitate its acquisition by JP. After that, I got another assignment, which was the Fed established what's called the primary dealer credit facility at the time, which was using 13.3 to establish liquidity backstops for the primary dealers. So that was kind of a new innovation for us. And as a result, the Fed sort of formed a team to monitor the primary dealers and try to learn about their liquidity status, focusing especially on those that were not within the Fed Bank Holding Company umbrella. And there were some really large ones that were outside of the Fed Bank Holding Company umbrella at the time. So I think we were looking at Lehman, we were looking at Merrill, we were looking at Goldman, we were looking at Morgan. So that I got hoovered there in like April. That gig lasted about 6 months until things took a turn again, and some of the pressures that those institutions were facing came increasingly to a head. And then I got pulled back into the legal department, where I worked on implementing the various 13.3 usages that were approved by the Board of Governors. So not just me, but everybody else at the Fed, we worked on a lot of things back then. We set up a commercial paper facility. We set up a facility to lend on a non-recourse basis against asset-backed securities. We lent via swaps to other central banks so that they could downstream liquidity to institutions in their markets. It was quite a busy time. The New York Fed, was kind of the emergency responder, though. Like there was only so much that we could do, and it wasn't just the New York Fed. There was plenty of other activity happening around other agencies. But emergency liquidity was just couldn't do it all, as you know. And while we may have mitigated many of the worst effects of the financial crisis, there were still many bad effects. So you really did need Congress and the fiscal authorities to come in and establish, equity injections into the banks and a stress testing regime and all those other things that eventually kind of brought the crisis to heel. So that's kind of the story of the Fed in 2008 and my story at the Fed in 2008. I'll just flip, if I have any more time, to just flip forward 12 years. I'm not a very imaginative person, so I remain at the Fed. Now my job is to oversee the lawyers that work on markets and supervision matters. So my team had a very busy spring and summer this year. We were sort of ejected from our offices physically in March. But then quite immediately needed to go to work to try to deploy those liquidity facilities that Professor Judge talked about. And I will say that it was not something I had in mind that it would be helpful that we had been through this 2008 experience and were ready to act in 2020. But I think it was clearly a case that was true. We had sort of been through some of this before. We had know-how, we had legal documentation in mind, and we had authority that had been used and thought about. So it did enable the Fed to act fairly quickly, which I think, as Professor Judge said, it was, the quickness of it was kind of the point. So, just very briefly, what we do, policymakers kind of left no stone unturned. You had a big usage of Section 14 of the Federal Reserve Act to do treasury market operations as that treasury market was coming under stress. We also had the 13.3 toolkit. I think Tom is going to talk about some of the emergency legal authority that we have, and I'll let him get into the legal issues there. Essentially, 13.3 amended by Dodd-Frank and the CARES Act was a tool that we used pretty aggressively. So Dodd-Frank sort of amended 13.3 so that we could do broad-based facilities in unusual and exigent circumstances. The CARES Act basically established an authority for Treasury to make investment in Fed facilities. And we used those authorities to do a couple of things. We sort of deployed the facilities that we used in the last crisis. So that commercial paper facility, that lending against asset-backed securities, the PDCF, they came back relatively fast. And then we had others that took some more work to do, and those came back a little slower, I think it's fair to say. So New York Fed, we did a corporate bond facilities. We did a primary facility to lend directly to firms and a secondary facility to buy corporate bonds. We also did a muni liquidity facility. We had to roll up our sleeves and learn a lot about the muni market pretty quickly. And I will say the Boston Fed played a very important role. They had kind of the hardest facility that came along the pike in terms of the Main Street facility. That was probably the hardest one to figure out how to do. I'm going to stop talking here, but maybe just to compare 2008 and 2020. I think it was really good that we had the experience of 2008, and it was really good that we had the authority, as sort of like affirmed change by Dodd-Frank and CARES, because I think it probably helped the policymakers, take the plunge to do some things. I think it was good that Dodd-Frank and CARES Act clarified some of the questions about how the Fed and the Treasury would work together. I think it was good that the Board of Governors and the Treasury Department each had a key to turn. And I think it was good as well that we had a bigger focus on transparency in 2020. So we had both like some required transparency from Dodd-Frank and oversight from Dodd-Frank and the CARES Act. And we went above and beyond and made a lot of choices to publish a lot of legal agreements and information about what we were doing. And final thing I would observe is just the physical environment of the crises were very different. I think Geithner's book about the crisis talks about how we did the first financial crisis in, I think he called it a third-rate Ramada Inn, because the New York Fed was being renovated at the time. So we had we worked out of kind of like what looked like cheap motel rooms. And this time, it was a very strange experience. We were all working at home using Skype, and we did all this stuff and worked with lots of different people who we actually never saw face to face, and it was kind of amazing how it all came together. So that's what I've got to say. I'm going to turn it over, I think, back to you, Jared and Tom.
Yeah.
Thank you.
Thanks so much, Jim.
We need to take a quick break and post the CLE code.
Okay.
So for the people who are getting CLE credit, the CLE code 1 is BACK, B-A-C-K. So please write this down, and you will fill it in on your survey at the end of the program. So CLE code 1 is BACK, B-A-C-K. You can probably guess what the next one is.
Excellent. Thank you, Josephine. So Tom Baxter, I think, is with us via phone. We had some technical difficulties with the Zoom. Tom, if you can hear me now, if you can press *6. Oh, it looks like you're unmuted now. Okay, so I will turn it over to Tom Baxter.
Jared, can you hear me?
Yeah, we can hear you loud and clear. Thanks, Tom.
That's great. So thank you first to Rutgers University Law School for hosting the program and for inviting me to participate. It's an especially timely point to look at Dodd-Frank, given that 10 years have elapsed since the law was enacted, and given that we're currently experiencing an economic shock arising from a global pandemic. I'm going to start by making 3 points that I'll embellish about Dodd-Frank. The first point, too big to fail, was a central focus of Dodd-Frank, but in the pandemic, it was just not a factor. And I'll talk about the reasons for this. Second, as Jim Bergen suggested, the Federal Reserve's authority to target liquidity with emergency credit under Section 13, subparagraph 3 of the Federal Reserve Act was hugely consequential, both before Dodd-Frank in the global financial crisis and after Dodd-Frank in dealing with the pandemic. So that would be my second point. And then the third point, Dodd-Frank was also important in stimulating a build out in the discipline of risk management. And in my view, this discipline was highly consequential in the pandemic. So let me go over each one of those points. First, let's take up the fact that the Dodd-Frank provisions dealing with too big to fail didn't play a part in the recent pandemic. And Professor Judge touched on one of the fundamental reasons. One of the fundamental reasons is that the pandemic presented a public health crisis and not a financial crisis. It's true, of course, that it generated a tragic economic shock that we're still dealing with, but the basic crisis was a public health crisis and not a financial crisis. Now, there was a great deal of concern, and you can see it in Dodd-Frank, about too big to fail institutions. You can see it in Title II, which creates a special insolvency regime, and you can see it in the amendments to Section 13, subparagraph 3, which restrict the Fed's ability to save an institution from insolvency and thereby incent the use of the special insolvency regime in Title II. But none of those things were a problem with respect to the pandemic. While many of us have spent significant time trying to figure out how you would actually resolve an institution under Title II of Dodd-Frank, none of that came to be important, fortunately, during the economic shock that resulted from this horrible public health crisis. And I think all of that underscores the fact that it is first a public health crisis. But I also want to address the point that it isn't simply luck that we didn't have a problem with a too big to fail institution. Jim Bergen mentioned one of the reasons, and one of the reasons relates to capital and liquidity and lessons learned as to the need for capital and liquidity, particularly with respect to too big to fail financial institutions. But that's not the sum total of the reasons, and I'll come back to that when I return to my third point. Let me go to my second point about Dodd-Frank, and that is that the Fed's Section 13.3 liquidity providing powers were exceptionally important in both the response to the global financial crisis and also in the response to the pandemic. Some lending facilities, as other speakers have noted, provided liquidity to specific markets, and the Fed used those facilities in response to the global financial crisis and also in response to the pandemic. Facilities like the commercial paper funding facility to provide liquidity to the commercial paper market, the primary dealer credit facility to provide liquidity to the primary dealers, the money market mutual fund liquidity facility to provide liquidity to money market mutual funds, and of course the TALF facility, which provides liquidity to certain asset-backed securities. As Professor Judge noted, other facilities were new and innovative and built upon what the Fed had learned during the global financial crisis. Facilities like the primary market corporate credit facility and the secondary market corporate credit facility provided liquidity to investment-grade companies. The Main Street lending programs provided liquidity to mid-sized businesses. And then the Fed also constructed the Paycheck Protection Program liquidity facility, a facility to assist the Paycheck Protection Program, and particularly the Small Business Administration's program, providing credit relief to small companies. All of those are new and innovative. In constructing these liquidity facilities, both the new ones and the renewed ones, the Federal Reserve built on and improved the facilities and the lessons learned during the global financial crisis. Now, our audience is a legal audience, and I want to focus on something that I think doesn't get enough attention, and that is the marriage of Section 13.3 of the Federal Reserve Act and a tool of modern financial engineering, the special purpose vehicle. And I want to focus on four key elements of the technique used by the Fed both during the global financial crisis and during the pandemic. It involves four elements. First, the Fed forms a special purpose vehicle, a Delaware limited liability company. Second, someone, and in the pandemic, it was the Treasury Department using funds appropriated under the CARES Act, provides equity to the limited liability company. Third, the Federal Reserve then lends to the limited liability company under Section 13.3 and leverages the equity in the vehicle to create a vehicle with extraordinary capability and power. And then last, the Fed deploys the proceeds from the vehicle to the specific market in need of liquidity. This technique was seen for the first time in the global financial crisis, but it was used more aggressively, to use the descriptor that Professor Judge used, during the pandemic. And you can see it, this technique, being used in the Main Street Lending Facility, the PMCCF, the SMCCF, and then the facilities that were used in the past and renewed during the pandemic, facilities like the CPFF and the TALF. The healing power of such targeted liquidity, coupled with the capability and power of the vehicle, is, in my view, the economic equivalent of a wonder drug. So that would be my second point, and emphasizing not only the importance of Section 13, subparagraph 3, but the technique that the Fed perfected in the use of that specific emergency lending power. Let me turn to my third point. And my third point relates back to why we haven't seen a too big to fail problem arising in the economic problems that we've seen from the pandemic. And we talked about the importance of capital and liquidity. We've talked about the importance in distinguishing crises, this being a public health crisis, not a financial crisis. But I want to also point out what I think is another unheralded feature of Dodd-Frank that helped us during the pandemic, and that is the build-out with respect to risk management. With respect to Dodd-Frank, there are many provisions that have led to the rise in the discipline of risk management. Dodd-Frank inspired board risk committees. It inspired risk functions headed by chief risk officers and staffed by qualified risk professionals. And it also stimulated risk governance frameworks in financial institutions of all sorts. In one of the important after-action reviews done in the wake of the global financial crisis, the senior supervisors group, which reported to the Basel Committee, said that the global financial crisis represented, and this is a quote, a colossal failure of risk management, period, unquote. The architects of Dodd-Frank understood this. And in Dodd-Frank, they nurtured the growth of this new discipline of risk management. And you can see this in many different provisions of Dodd-Frank, including perhaps most prominently Section 165. But the build-out of the discipline of risk management is, I think, one of the most important post-Dodd-Frank developments for financial institutions of all kinds, both banks and non-banks. And the build-out of the discipline has been based upon a crucial operating hypothesis, and that is that you need to be equipped to address the financial effects of an economic shock, and you must presume that you will not be able to predict with needed precision the nature of every trigger that could cause economic shock. Now, I want you to think about this with respect to what we saw during the pandemic. The pandemic was a trigger to an economic crisis, and no one in the world saw it coming. Through stress testing and other tools of modern risk management, both too big to fail institutions and other significant financial companies became better prepared for the effects of the shock we experienced as a result of this public health crisis. And this is a simple but important point. The build-out of risk management has had enormous consequence, and in many ways, it's attributable to Dodd-Frank. Well, I know my time is coming to an end. Let me just say in closing that during the global financial crisis, I was on the playing field running plays for Team Federal Reserve. In the economic crises arising from the pandemic, I've been providing advice at Sullivan and Cromwell to other teams, but I've been well positioned to closely observe my former Federal Reserve colleagues, including but not limited to Jim Bergen. Permit me to state my admiration for the performance, and I think it's been nothing less than extraordinary. And I look to my former colleagues with profound admiration and respect. I have only 2 words to add, and I'll add them as a grateful citizen and not as a speaker, and that is, thank you, Federal Reserve.
Wow. Thanks a lot for those remarks, Tom. I think I speak for all of us in our gratitude for your service during the last crisis and for taking the time to join us today. You are a dean of the banking bar and a wealth of knowledge. So thank you for sharing that with us. Charles G., you have the toughest job of the entire webinar to follow Tom Baxter. So I'll turn it over to you to talk us through your experiences in the Senate and give us a little bit more of a political perspective of how Dodd-Frank had sort of formed, how the salsa was made.
Thanks, Jared, and thank you to Rutgers for inviting me. It's good to be here, and do have the honor of running anchor for this relay, which means we have no time left. So let me just make 2 quick points. First, I'll follow up on Professor Judge's point and connect the political economy of the last crisis versus this one. And second, I'll just make a brief observation about Dodd-Frank. First, I got to work on both the TARP legislation and Dodd-Frank in Congress before going to the FDIC to serve as the general counsel. And I got to live the intersection of law and public policy, which to me is the most interesting part. And I think the main difference, well, 2 differences between last crisis and this crisis, I think that contributed to the relative slowness of the legislative response in the last crisis that Professor Judge observed. So first of all, the last crisis, to this day, there is no agreement on what caused the crisis. And Professor Bratton, in my mind, correctly laid out the cause of the last crisis. But to this day, there are people who say that it was the government focus on affordable housing and predatory borrowers who caused the last crisis. So if you can't agree on the cause, you can't agree on the solutions. So that, I think, partially delayed any legislative response to the last crisis. The second one that cannot be overstated is the deep, broad anger during the last crisis. Congress, during TARP legislation, was being asked to vote to make every one of us pay to save people who burned their own houses down. And you can imagine how popular that was. And I can tell you that there are members of Congress who voted yes on the TARP legislation, who did not get reelected, never came back to Congress, ended their career. So that does not contribute to fast lawmaking. Whereas this crisis, everybody agrees that it was an exogenous shock. It was an asteroid hitting Earth. So we all have to pull up our sleeves and work together, which you saw with the CARES Act that to me was lightning quick in terms of a legislative response. So I think those 2 factors contributed to how slow the response was to the last crisis. and sort of related to that is my second point, which is an observation about Dodd-Frank. Notwithstanding the deep and broad anger against the banking industry during the last crisis, there was only so much political weight you could put on Dodd-Frank. As you may all know, in the Senate, it takes 60 votes because of the filibuster to pass legislation that has any kind of opposition. And back in 2010, there were only 57 Democrats. So we needed to find 3 Republicans who were going to vote yes to impose new restrictions on the industry, which was heavily lobbied against. And I'll just make the observation that no matter what your policy bent is, and there were many great policy ideas that we could have put into Dodd-Frank, the unfortunate truth is if we made Dodd-Frank any tougher on the industry, we probably would have lost 1 or more of the 3 Republicans we needed to pass the bill. So to me, Dodd-Frank is sort of the outermost limit of how tough we could have been with the industry in terms of passing legislation. So with that observation, let me turn it back over to you, Jared, because I know we're out of time.
No, I think we still have a fair amount of time. We're going until 1:30, but I appreciate your remarks, Charles. So I think at this point, I'll just open it up for a few questions that I'll pose to the panelists. This may be a bit challenging because we don't have a lot of the sort of physical in-person cues of when people are talking, but I guess we'll do our best. I think Professor Judge and Tom, you guys both sort of touched on this notion of banks being too big to fail. And I guess a question just to pose to the broader group is that still true, especially for the largest firms, or now they seen as resolvable and really a source of stability and support for the economy as opposed to this great risk that may lead to systemic failure. So I'll start there and open it up to the group.
I'll jump in quickly since I was, I think we just don't know, right? And I think that was my initial point. Like, this was not a test of the system we put in place to deal with too big to fail. It was a partial test. It was a significant shock. We managed to get through the shock. And I do think without question, building on Tom's point, we had better capitalized banks, but all kinds of institutions, including insurance firms that still managed to escape the federal regulatory umbrella I think they do have much better risk management in place than they did going in 2008. That being said, we still have a deeply interconnected system, and we still have a huge sector looking at the financial system that is outside the banking system. So while we've ramped up capital in the banking system, and if we look even at the early stages of this, a lot of the mortgages are coming outside of the formal banking sector, particularly to different types of borrowers, a lot of the financial support for small businesses. So it's about too big to fail, but also kind of the question on the other side of too big to fail is always kind of what are the macroeconomic conditions that we're willing to accept. And we've seen a continued growth in asset management, a lot of questions there. And again, they're very different entities, so they're not subject to directly the same types of run dynamics. But I still think that there's plenty of reason for concern, particularly when we look to non-banks. And I think I'm personally very grateful that we're going to see another round of stress test, just kind of given the ongoing uncertainty.
I'm going to interrupt for 1 second and share the second CLE code. It should be up on your screen. CLE code 2 is forward, FORWARD. Please write this down and include it on your survey, which will be at the end of the program. CLE code 2, forward.
Thank you, Josephine.
Okay.
So does anyone else have any sort of comments or remarks as it relates to too big to fail institutions and their reputation during the last crisis as opposed to now and being seen as a source of stability or support for the U.S. economy?
I'll just add that with Catherine, I think there are a lot of banks that remain too big to fail. It just takes a different kind of crisis to drive that point home to us, and that we're all very grateful to the reforms in the wake of the financial crisis to have forced the recapitalization of the banks so that they're better able to weather what problems we've had this year. I note, though, that one of the side effects of the reform of bank regulation is the reappearance of non-bank securitizers in a lead position in the residential mortgage market, okay? There is a shift away from bank lending to non-bank lending. These lenders are not too big to fail. Just a guess, okay? Last time around, 3/4 of them disappeared. Okay, they're back. They are lightly regulated. And when we had volatility in March, they were one of the voices that was yelling very loudly about their problems. The Fed's intervention stabilized the mortgage market, and so they're fine right now. But that's a weak point, and there are other weak points. We'll see.
Right, and following up on the point about migration risk to the non-regulated, non-bank sector, the architecture of Dodd-Frank was that both the front end and the back end protections. So the front end protection was with the FSOC and FSOC's ability to designate non-bank financial institutions as being systemically risky and therefore subject them to supervision by the Fed. That was the front end. And the back end was Title II of Dodd-Frank that gave the FDIC the ability to resolve large institutions. The issue now is that at the front end, this administration's Treasury Department has made it impossible to designate any non-bank financial institutions. So you've pretty much lost the front end protection, and the back end protection has never been tested, and knock on wood, hopefully will never be tested, but we'll only know if it works when it happens.
Tom, were you trying to jump in there? Did you have any thoughts you'd like to share?
Yeah, the one that I was going to offer up. Can you hear me, Jared?
Sure. Yeah, we can hear you.
Is to point out another important element of the global financial crisis, and that is it revealed a fundamental change in a business model. So if you just in your mind's eye think about January of 2008 and visualize the independent investment bank that existed back in January of 2008, you'll think of entities like Lehman Brothers, Bear Stearns, Morgan Stanley, Merrill Lynch, and Goldman Sachs. If you now think about December of 2008 and think about who's remaining among those 5 iconic independent investment banks, you'll conclude that the answer is none. Lehman, of course, failed. Bear Stearns was rescued, as Jim Bergen pointed out, by the Fed and brought into the protective arms of J.P. Morgan Chase. So it became part of a bank holding company. Morgan Stanley and also Goldman Sachs became bank holding companies, and Merrill Lynch was acquired by a bank holding company, Bank of America. And so what I think people also need to recall is that there was a fundamental change in the face of American finance during that important year of 2008. And it was a change in a business model for the independent investment bank, a recognition that given what those independent investment banks were doing, they couldn't fund themselves in the wholesale market. So that had nothing to do with Dodd-Frank. It had nothing to do with any change in law. It had to do with a fundamental economic circumstance and a change in the business model. And I think sometimes we lose sight of the fact that there are real changes going on in the real economy. And those real changes sometimes produce effects that are at least as great as the effects that are written in a legislative enactment.
Great. Thanks,
Jared, could I offer a thought?
Jump in, Jim.
Yeah, I think sort of on the big question of whether too big to fail has been wrestled to the ground. I think modesty is important. So I think there have been a lot of good things that have happened in regulation in the time since the financial crisis. The increases in capital, the elaboration of liquidity as a focus of regulatory inquiry. Stress testing has been hugely important, both I think on the side of the regulators as they perform it and the institutions as they learn to do it. And as Charles said, the resolution mechanism is now there, and there's a lot of attention that's given on the side of both the official sector as they prepare to use it and institutions as they plan. They have to do the required planning for resilience. That's all good. Modesty is important, right? So the financial system, we don't know what we don't know, and part of the point of all those tools is to prepare yourself for what you don't know, so that there's more loss absorbency in the system. But there's things that we don't know, surely.
Thanks, Jim. So I guess just switching gears a little bit, and Charles, I wanted to touch on something that you mentioned in your opening remarks. So you underscored this deep, broad anger during the last crisis, and in what seems like 10 years ago, earlier this year, the firefighters, right? Ben Bernanke, Hank Paulson, and Tim Geithner did a panel at Yale that I think might have been in partnership with Brookings, and they talked about the challenges in the messaging of TARP legislation and a lot of the extraordinary relief that was provided to the financial system. And Charles, with you being one of the boots on the ground, and Jim and Tom, I'm sure you guys have experience directly with this as well. So I'd just be interested in your views on how the U.S. government could have did a better job of communicating the extraordinary actions that were being taken and connecting that to Main Street, connecting that to homeowners and the like, because I think some of that, a lot to the credit of Tim Geithner in sort of confessing to this, but the messaging around that could have been improved, and maybe from a political perspective, Charles, how that led to a lot of the sort of populism and a lot of the rhetoric and blowback against large banks.
Yeah, I'm not sure that it was really any issue with the messaging as opposed to the message. There's not a whole lot you can do to put lipstick on a pig, right? So people aren't stupid. They know that the bankers took home outsized bonuses by taking a lot of huge risks. And then when going got tough and things started blowing up, the bills are paid to the taxpayers. I don't know what communications genius could put a spin on that and make that a palatable sales pitch to the American voters. Because I'll tell you, during the TARP process, every congressional office was being flooded with hate mails and hate calls. And it took a lot of bravery for these politicians to vote yes on TARP. Just thinking back, I just don't know what anybody could have said to the average Joe on the street back in 2007, 2008, saying that, the government has to give out $700 billion to people who just caused this crisis.
So Jared, this is Tom. One observation, again, reflecting on the global financial crisis and in complete agreement with the points made by Charles. If you think back to the global financial crisis, the average American looked at the Federal Reserve rescuing Bear Stearns, rescuing AIG. At the very same time, ordinary Americans were being put out of their homes. And, I think that is a part of why there's such anger, is it just was so unfair. And when you contrast what happened during the global financial crisis to what was done in the aftermath of the pandemic or in response to the economic shock from the pandemic, the government learned. And so you had initiatives like the Paycheck Protection Program. You had initiatives like Professor Judge mentioned, people getting tax rebates if they made less than $100,000. You had a program called the Main Street Lending Program. Clearly, there's a lesson learned in the nomenclature used for that lending program. And you had significant work being done by the SBA with some assistance from the Treasury and the Fed on small business lending. So I think that the responses are very different and in many ways are more fair. And I think that the fairness has had a real effect with respect to the hostility that was apparent after the global financial crisis. It is different with respect to the response to the pandemic.
Great, thanks, Tom. I think I have one final question for the panelists, and then maybe we can take a question or two from the audience for if we have time permitting. So, today's webinar is 10 years after the Dodd-Frank Act, right? Looking back and looking forward. So, this question is really about the looking forward portion. So, Professor Bratton talked about, the collapse of financial markets during the 2008 crisis, and Professor Judge really did an excellent job of tying, the Fed's actions in 2008 to their more recent actions during the COVID pandemic. So we're 6 days away from a general election, or rather the last day of voting, considering how many Americans have already voted. So I'd be sort of remiss not to get this panel's thoughts on where we're heading in the world of financial regulatory reform. So, part of this is looking into your crystal ball, and if we do have a change of leadership in the Senate and in the White House, we're likely to get certain priorities and agenda items that will be significantly different from what we've seen in a somewhat deregulatory state over the past 4 years under the current president. So I'll open it up to the floor just generally for reactions of where they might think things are headed, either with a continuation of the current administration or a change in leadership.
I'm not going to chime in on where I think things are headed, but I'll chime in quickly on where I think things ought to be headed. And that is, I think we've learned a lot over the last 10 years, and we learned a lot even before the pandemic, and we learned more through the pandemic. And I would like to see some of those lessons actually translated through to both regulatory reform by regulatory agencies, and also, I think we need changes at Congress. I think Charles did a great job explaining that they got the best they could under the circumstances with Dodd-Frank. It was a massive improvement relative to where things were. But as he further explained, we have learned over time that some of those tools didn't work the way that they were supposed to. We still have a huge problem with non-bank finance. The front end has not worked. There were some efforts to make it work originally, but it was really slow to get off the ground. It hasn't worked afterwards. We still don't have coordination. So I think there's a lot of work to be done with FSOC. There's a lot we still just don't know. So I think OFR needs to be revitalized and given expanded powers and perhaps more independence to just make sure we have the information that we need. And I still think there's a lot of question about macroeconomic tools. And when we saw the efforts to do anything with leveraged loans, it didn't go anywhere. And when I'm looking at the future, I mean, I think in terms of debt overhang, that could still be a real problem, a real drag on the overall economic recovery. So I think there's still, I think we've, a lot of it we already know. I think that there were some real positive changes that have been made. But I still think that there's a lot of work that can be done. I don't think it's probably going to be the top priority of a change of administration, but that doesn't mean it might not get done at some point.
So following up on that, I'll just make two points. One is something that taught me in the Army is that the defensive fortifications are only as good as the soldiers manning them. So Dodd-Frank put in a lot of cool new architectures and invent a lot of new toys for the regulators. But you know what? If there's nobody inside the bunker is just a really odd looking log cabin. So it requires the personnel and the willpower to use the tools that the legislation gave the government. The second point is Congress legislates generally, actually almost always, especially in the financial space, in reaction to crises. I just haven't seen any sort of prophylactic measures, any preventative measures being passed in anticipation of something bad happening, right? Because you, as a legislator, but also as a regulator too, so it's both legislation and regulation, you need to be able to point to something tangible to be able to muster the willpower or forge a consensus to do something that a very vocal segment of the economy will hate. So I don't know that there's going to be any huge financial reform legislation passed absent sort of a second crisis, which we all hope does not happen. So really, even if there's a change in administration, I don't know that, especially with everything else happening in our society, I don't know that financial legislation is anywhere near the top of the priority list. So even if the administration changes, I think at least in the immediate future, the most you're probably going to see is at the regulatory level, some of the things either being reversed or refined, but I just don't see a huge Wall Street reform package passing again in the near future.
Great. And Tom, I see that you're unmuted. Do you have anything you'd like to add?
So I agree with Charles that appointments matter. And I look back at the global financial crisis when we had Ben Bernanke, Tim Geithner, and Hank Paulson at the helm, and that was hugely consequential. I look at the pandemic and to Jay Powell and Steve Mnuchin, also a great thing that we had people who are knowledgeable and had the will to act. So that's one thing that I would underscore is that appointments matter, and particularly appointing people who have a will to step forward and to deal with crises. So that's a key piece. I also think that it's significant to have people in place who've learned the lessons of the past, and so I think it is really important for programs like this to focus on what we have learned, looking backward, and then also looking forward and applying those lessons to the challenges that we'll face. And then not to lose sight of that fundamental point about risk management. We won't be able to visualize every crisis trigger, but we know what the effects will be, particularly the economic effects, and being ready to deal with them is critical.
Thanks, Tom. So I guess I see there are a few questions in the Q&A box. I'll try to tie as many of these together as possible in the 5 minutes that we have allotted left. One of the attendees asked, do you think Dodd-Frank focused too much on too big to fail given the amount of industry discussed versus a focus on consumer protection reform? And then are there any parts of Dodd-Frank that should be further reformed?
Can I address first?
Sure.
Actually, there's a lot of consumer-oriented stuff in Dodd-Frank, but it's not what we ordinarily think of as consumer protection. It is mandated financial conservatism. Dodd-Frank effectively prevents risky mortgage loans from being made, limiting access to mortgage credit. And it's doing that successfully, as far as I can tell. The interesting thing about Dodd-Frank is it does not reciprocally impose financial conservatism on Wall Street. Okay, you want to package a CDO, you can package a CDO. Okay, Dodd-Frank does not stand in your way. Okay, so that's a limited answer, but for me, that's one of the salient structural aspects of legislation.
Do others have any thoughts that they'd like to share?
I mean, we haven't really talked too much about the CFPB today, and we only have an hour and a half, so there's a lot in Dodd-Frank, and there's been a lot of people who have worked hard at the CFPB. So, I don't know if that's part of it. One point I would make is that I don't think you're ever gonna stop the financial system from changing and changing what kind of measures you need to take in response. So it's almost too much to ask of a single statute to try to cover everything. I mean, just think about all the different things regulators think about now: treasury market reform, reference rate reform, cybersecurity. It's just going to keep on coming. So you're going to need continual response.
So the way I think about Dodd-Frank's sort of fundamental architecture, it's one way to look at it is it's a three-legged stool. One leg is systemic risk regulation, as embodied in Title I and Title I and II of Dodd-Frank. Second leg is consumer protection as channeled through CFPB that Jim just mentioned. And the third leg is something we haven't really talked about, which is derivatives regulation in Title VII of Dodd-Frank. And as far as I can tell, the main parts of those three legs are still intact, even through various efforts to gut Dodd-Frank the past 4 years. Granted, a lot of Dodd-Frank punted or delegated to the regulators, both the implementation and the enforcement. So it does depend on the willpower of the regulators and Treasury Department to exercise and use these tools that Dodd-Frank gave them. So it is subject to political winds in that sense. But as far as what the legislation itself could provide, I think the three legs are still intact and, in my view, fairly well balanced because all three issues needed to be addressed.
So Jared, I think we're out of time. Let me just thank you for moderating and the panelists for participating and the audience for joining us. Please stay tuned for our next program. You can find or will be able to find a recording of this program on the Center for Corporate Law and Governance website, cclg.rutgers.edu. And thank you again.
And here is your CLE. What? Sorry. Okay, sorry, I lost my CLE screen. Oh, there we go.
Okay, Doug,
Thank you. That should be enough time for people to capture the QR code. If not, it will, when they close out, it will appear in their browser. Thank you, everyone.
Thanks, Josephine.
okay, excellent.